Hi and welcome to the channel. In this video we're going to discuss the most recent sell-off that we've had in the US equity markets. We're going to talk about some of the causes that may have contributed to it, but more importantly we're going to talk about what to expect from the US markets going forward. So let's talk about the markets. Obviously the big news has been the historic sell-off that we've seen on Wall Street over the course of the last week. It's been an absolute bloodbath, a sea of red anywhere you look in the market. The Dow Jones Industrial Average has lost over 4,000 points this week. We see a similar pattern when we look at the broader index of the Nasdaq as well as the SP500. If we skim through the headlines, we quickly get the impression that the coronavirus is largely to blame for the sell-off that we've seen in the US and European equities. I disagree with that. I believe there are other more significant factors at play here. I'll explain why, and I'll share the issues that I'm paying attention to that I believe offer a far more reasonable explanation for the performance of the US markets that we saw last week. But before we get into all that, let's talk about the coronavirus. The coronavirus has originated in mainland China on December 31st, 2019. So far, there are over 85,000 infected cases all over the world. The vast majority of them are concentrated to mainland China. It was 78,000 last time I checked. Although the virus has spread to other countries, the numbers are far smaller. For example, the United States only has about 60 cases. Following the outbreak, the Chinese government has taken extreme measures to contain the virus. Almost half of China's population, that's 780 million people, are under some sort of travel restriction. Adidas has reported an 85% drop in their Chinese business. Starbucks has had to shut down many of its locations in China, although as of Friday, it is reported that 85% of those locations are back up and running now. So it seems that most of the affected cases, as well as most of the disruption, is in mainland China. So given that, you would expect the Chinese markets to have dropped significantly more than their US counterparts. If we look at the numbers, going back to December 31st, which is when the coronavirus first broke out, we see that the Dow Jones Industrial Average, the US market, has actually lost substantially more than the Hang Seng, the Chinese counterpart. Another inconsistency that I see in the whole coronavirus story to explain the performance of the US market is the timing. The worst of the crash in the US markets happened last week. That's almost 2 months after the coronavirus broke out. Why such a delayed reaction? Are you trying to tell me the markets are really that stupid that they can't figure out the coronavirus? It takes them 2 months to go over this information? So if not the coronavirus, then what is it? The first issue that I want to discuss is the repo market. Right off the bat, I just want to say the repo market has nothing to do with the scenario of the guy that didn't make his car payments and is now getting his car repossessed and the car is going to be sold off at all. The repo market is crucial to providing liquidity, or cash, to the whole financial system. I can't overstate enough how important this market is to the overall stability and efficiency of the overall global economy. The repo market allows large institutional players, such as banks, insurance companies, and pension funds, the ability to deposit cash overnight to get some interest, or get an overnight loan on cash in exchange for paying some interest. Now at this point you might be asking yourself, why would these large institutional players even be in a position where they need to borrow cash? Aren't they loaded? Aren't they sitting on piles and piles of cash, especially banks? That's an excellent question. To answer it, it's important to understand that corporations don't generate value for their shareholders by sitting on mountains of cash. In fact, it's really bad for a corporation to sit on a lot of cash, simply because the cash is not earning anything. It's not earning interest, and as it sits there, it's consistently being eroded by inflation. Therefore, it slows down the overall rate of growth for the shareholder of that company. Banks especially will try to have as much of their money invested at all times as possible and as little of it sitting around in cash. In part because they have front row access to the world's capital markets and they can very easily go in and out of investments at the click of a button. To keep assets invested efficiently, corporations will try to have just enough cash on their books to cover their day-to-day needs, but no excess sitting around idly. For this reason, banks spend a great deal on budgeting their daily cash position. Now sometimes the budgets don't line up with the actuals, and the bank or the corporation is left with a shortage or maybe even an excess of cash on their books. With the repo market, these institutions can easily take care of their shortage problem by going to the repo market and borrowing some cash in an overnight loan. Or they can invest their excess cash into an overnight loan in the repo market as well, therefore ensuring that their cash is invested and it's not sitting around idly. Now, when the next business day rolls around, obviously the bank starts to see cash movement from their regular operations, and the budgeting process starts all over again. If it wasn't for the repo market allowing these large institutional players to get access to overnight cash, they literally would not be able to afford to have even a small shortage. Because of that, they would be forced to have higher amounts of cash sitting on their books just in case they need it as an insurance policy. Now, overall, if you can picture, if all corporations start doing this, there's going to be more and more capital idly sitting in the economy, which is going to slow down the overall growth. Now, in addition to the large institutional clients coming to the repo market to borrow or lend their excess cash, there's another very important player in the repo market, and that is the Federal Reserve. Now, I'm sure a lot of you are familiar with the Federal Reserve. You hear them announcing their target interest rates and releasing their minutes on a regular basis. So when the Fed announces their rate decision, they set a target. Their work doesn't end there. The Fed makes sure that the rates stay within their announced target by actually participating in the repo market amongst others. If the rates in the market start to go up above the target levels, then the Fed comes into the market and basically injects a whole bunch of cash, therefore satisfying the demand for cash in the market and driving interest rates back down to within target. Alternatively, when interest rates slip below the market, the Fed will go in there and borrow cash, therefore increasing the demand and driving the interest rate up to their targeted levels. At this point, I just want to say that I am grossly oversimplifying the operations of the Federal Reserve and the repo market for the purposes of this video. But this topic is very important, and I encourage everybody to do a quick Google search and start familiarizing themselves with it. Now, many people dismiss this area of the market as very uneventful and boring, and they're right. But keep in mind that the majority of financial panics that we've had have always originated in the credit markets. Watching the credit markets can serve as an important indicator for what's to come in the stock market. So this area is extremely important to watch, especially now when we're in an age of negative interest rates where we've never been before. So now back to the repo market. What's going on there? If we look at the chart of the rate in the market, we see a huge spike on September 17th. This is an extremely important event because it's so unusual to have such a huge spike in what is generally an uneventful market. These are essentially short-term treasuries, very short-term loans. It's supposed to have the least volatility and the least risk of any market. It's not some penny stock that jumps up and down left, right, and center. So let's take a closer look at what happened in the market. Because interest rates rose, we can conclude that there was a net demand for cash. The Fed was obviously in the market injecting cash, but then they simply ran out of cash. And the market was left to its own devices, and the market pushed interest rates from 2 to 8% without the intervention of the Fed. So that gives us an idea of just how huge of a demand for US cash there is out there in the repo market. Now, the Fed obviously fixed the problem, as we can see by the chart. The rates are back to normal. How did they fix it? They fixed it by injecting historically large amounts of cash into the market. And their plan going forward is to continue injecting these high levels of cash in order to maintain the target rate at the low rates that they want. So what are the takeaways from this big event? The first takeaway is the fact that we have an overwhelming demand for US cash in the market. And the only thing feeding that demand right now is the regulators, not the actual market itself. The other takeaway is that the Fed set the rate, but they could not maintain their rate. So they effectively failed at monetary policy. Maintaining low interest rates in the economy is putting a huge strain on the Federal Reserve. And the Federal Reserve is showing signs of cracking. So what happened after that? The Federal Reserve stopped lowering rates. Their last rate decision, they decided to keep rates steady, and they committed to injecting trillions of dollars into the repo market to maintain liquidity. So they essentially increased the float that they come to the market with every day to satisfy the huge amount of demand that's out there. Now that has got interest rates under control and has alleviated the worst fears of investors, the complete failure of the Fed. Having said that, I would argue that they actually fixed the symptom, but not the disease. The disease can come back to haunt you. The big driver of this mess to me seems to be the huge demand for the dollar. And nothing's really being done to address the demand. We just increase the supply to cater to the demand. Jerome Powell of the Federal Reserve tried to explain the increase in demand as having something to do with tax time and payments that corporations are making in tax time. Doesn't make a lot of sense to me. Is this the first time a corporation is paying tax? Surely corporations could have budgeted. Surely the Fed could have budgeted for something as predictable and expected as tax time. And what happens if the demand for the dollar continues to rise? At what point does the Federal Reserve draw the line and say, okay, we can't just keep printing more cash in order to go the opposite way that the market wants to go? If the Fed fails, and I mean really fails, not this temporary overnight stuff, like I'm talking people actually lose confidence in the Fed, we're walking into a recession that will make 1929 look like a walk in the park. Can you imagine what would happen if corporations didn't have enough cash? They would need to start liquidating their assets. What happens in a market where everyone's trying to liquidate their assets and there's a shortage of cash? Values absolutely plummet. While we're on this topic of a jump in interest rates, I think it's a good idea to mention the yield curve. A lot of you may have heard of the yield curve when it inverted in September. It means that as opposed to a typical yield curve where long-term loans pay you a higher rate of interest than a shorter-term loan, the yield curve inverted and went the other way, where a short-term investment actually pays you more interest than the longer-term. Well, the interest rates in the repo market are those short-term interest rates that are on the tail end of the yield curve that shot up, therefore inverting the yield curve. The inversion of the yield curve is seen by many investors as a very good indicator of an upcoming recession in the stock market. And it seems in this case that the indicator did a good job once again. And it makes sense if you think about it. An inverted yield curve signals a shortage of cash in the market. Shortage of cash is another way of saying constrained liquidity. Liquidity is essential to the smooth operation of the economy. If you take away liquidity, everything falls to dust. So this event in September set the scene and it unnerved a lot of investors. But markets continued their bullish trend, but something really shocking and unexpected has scared the nervous investors into a historic sell-off that we witnessed last week. From February 19th till now, the Dow Jones has plunged close to 13%. Just for reference, the Hang Seng, the Asian market, only lost about 5% in that same time period. So obviously, whatever is scaring capital in the States is in the States. And my money is on this man, Bernie Sanders. Although politics is something I try to stay away from like a plague, I've reluctantly come to accept that you can't do any analysis if you're not looking at the political system, especially in today's age of high government, high regulation, high tax rates. Political policies have a huge impact on the markets. So the second topic I want to talk to you about is the upcoming US election in November 2020. Now at this point it's fairly clear that we're going to see President Trump run for re-election. What is not clear is who his contender is going to be. So let's take a look at what's happening in the Democratic Party. Up until recently, there really wasn't a clear idea of who was going to be the favorite. There was a lot of speculation, but nobody really knew. The Democratic debates were a bit of a joke, with people speaking Spanish and all sorts of virtue signaling. But in February, the Democratic primary race began, and we got a sense of what to expect going forward. Leading the polls by a large margin was Bernie Sanders. Bernie is famous for his left-wing views, and some people would even go as far as to call him a socialist or a communist. Socialism has historically been very bad for capital, very bad for economies and human beings in general. It has been tried before, and the results are consistent. It usually results in millions of people dead, millions of lives ruined, and the economy is absolutely ruined. Just take a look at Stalin's Soviet Russia as an example. Now at the same time, socialist policies do sound very tempting and appealing. They generally go along the lines of tax the rich and feed the poor. This message obviously resonates with a lot of people who identify themselves as not being rich. Although I'm sure many of those people would be surprised if they actually looked up their tax authority's definition of being rich. As an example, if you're earning over 125,000 Canadian dollars, the Canadian authorities deem you rich enough to pay over half of your income in taxes. So when they get their socialist tax bill, people generally start to understand why socialism is bad. Of course, at that point, it's already too late. Many countries have tried to build some sort of social utopian system because it sounds so appealing, but so far no one has been able to do it successfully. So the rise in popularity of a candidate like Bernie Sanders, in my opinion, would scare capital much more than some virus that has a death rate that's comparable to the flu. I think a better story for last week's headlines should have been Bernie Sanders campaigns through the United States, markets are plunging at 13%. The effects of this panic are so large that they're even felt in China, where the markets just started to recover after the coronavirus outbreak, only to plunge again to their lows with the threat of Bernie Sanders. Well, at this point you're saying, this is lovely, thank you very much for the scenic tour of the world's current events and political intrigues delivered with a hint of tongue-in-cheek humor. But the big question in everyone's mind, I'm sure, is what do we do in this market? Is it going to go lower? Should I sell my stock? When will this bloodbath end? Well, the way I see it, for a long-term moderate risk investor, this is actually a great opportunity to go out in the market and do some shopping. All your favorite stocks are probably on sale right now. So if you love the stock at a January price, you're going to love it at last week's price. Now, of course, some people may already have money in the market right now, and they're bleeding. For those people, I think it's important, as always, not to panic. If I was in their shoes, I definitely wouldn't rush to sell my quality US stocks, except for maybe the ones in the financial sector. Of course, it all depends on the stocks, but at this point, if you haven't sold, don't go selling just because the market is going down. I'm confident that this is a short-term panic, and in the long run, the US will continue to do well. Having said that, the repo market issue that I mentioned earlier is unsettling. There are certainly sparks showing in the repo market, and those sparks could potentially set off a huge fire, the effects of which would be felt not just in the US but around the world, given the world's reliance on the US consumer and US capital markets. As for Bernie Sanders, it could be argued that he has a shot at leading the Democrats into the presidential election, but given how many people from his own party have spoken out against him, I don't think he'll even get that far. And I'm confident in the US people that come November, even if they're given the choice to elect a socialist government, the most diehard Democrats and diehard Trump haters will likely pass on that opportunity because they still remember who won the Cold War. So Bernie is not something I'm too worried about. However, it would be nice to see him maintain his lead in the primaries race, just so he continues to rattle the market some more as the Democratic primaries wrap up. I'm confident that the worst of this crash is behind us, but it's not over just yet. Ultimately, I'm not expecting a breakout until after November, when the market gets some clarity as to what's going on in the US political system. So that's all I have for today. If you enjoyed this video, please like, comment, subscribe, and I hope to see you next time. Thank you.